Good evening, everyone. On Wall Street, every little bit helps, and a strong stock rally today pushed the Dow Jones Industrial Average into positive territory for the year, up by a fraction, but still on the plus side. But words of warning after the close from one of those Dow stocks could temper the tone of trading tomorrow. Cisco Systems is a closely watched tech bellwether company, and on its earnings conference call, the CEO issued disappointing earnings guidance, warned about emerging markets, and announced plans to cut 6,000 jobs. As for its quarterly results, the computer networking equipment maker topped Wall Street's forecast by posting earnings of 55 cents a share. That was 2 cents more than estimates. Revenues also came in better than expected, even though they were basically flat from a year ago, as the company faces tough demand for its new line of high-end switches and routers. Cisco shares initially rose, but then reversed course on those comments from the conference call.
Cisco, along with several other U.S. tech giants, has always looked to China for future growth. But now, doing business with Beijing is becoming more difficult and one of Cisco's biggest challenges. Josh Lipton has the story.
We have the opportunity to get to see what is going on in every country.
Cisco's CEO John Chambers knows that China represents a big opportunity for the tech bellwether with an IT market that's growing strongly. The problem is whether the Chinese government is going to allow Cisco to capitalize on that opportunity. China now accounts for about 5% of Cisco's total revenue, or some $2 billion. But business there has been tough, with orders dropping quarter after quarter. What's the problem in China? Call it the Snowden effect. Cisco executives say disclosures about the surveillance activities by the NSA are spooking Chinese customers. And the Chinese state media is stoking those concerns, saying that Beijing should punish what it calls the pawns of the U.S. government, specifically pointing to Cisco, as well as Microsoft, Google, and Yahoo. Analysts say China's real intention in this war of words is promoting Chinese tech companies over foreign rivals.
This is an opportunity for the Chinese government to say, hey, we have no concerns about our own products, and we understand exactly how those are made. And at the same time, it's a way, for China to sort of promote their own indigenously made products and try to drive those products forward.
And it's not just Cisco that's in Beijing's crosshairs. IBM, Microsoft, and Qualcomm also are facing challenges in the Chinese market. American tech companies are counting on rapid growth in China, with an IT market there that's expected to reach $111 billion this year. But given how Beijing is now acting, that doesn't look like something a lot of companies are going to be able to deliver to investors anytime soon. Josh Lipton, Nightly Business Report, Silicon Valley.